All right, guys, big releases today. Amazon, Apple, two of the five largest companies in the world, both reported. Let's check out how Amazon is doing after hours. Now they're down $8.37, but here's what's interesting. Let's look and see what they reported. Earnings revenue estimates of 155.03 billion. They reported 155.7, beating by 0.43%. Earnings per share, they crushed by 17%, reporting $1.59 versus expectations of $1.36. So, why is the stock down 4.5%? Guidance, all these other things, the tariff war going on. Guys, yesterday morning at 9:50 a.m. Eastern time, I posted on Twitter what has become my highest viewed post ever. 126,000 views in the last, 32 hours. And it was Amazon specific. In August of 2020, Amazon hit $175 per share. Today it's at $180 per share. Essentially zero growth of the stock price in 5 years. In the quarter of 2020 where this high was hit, Amazon did 96 billion in revenue and 6.3 billion in profit. This last quarter, they did 188 billion in revenue and 20 billion in profit. We're talking about the quarter ending 2024. Almost double the revenue, triple the profit. I cannot stress this enough. If you only look at share price to determine if you're right or wrong, you're probably not going to do well. There were some comments below, thought I was taking an attack on Amazon. Absolutely not. It was an attack on the way we are as investors. Amazon was the can't miss stock. Then it was Tesla. Now it's Nvidia. Do you see a pattern? And in 2000, it was Intel, Cisco, Microsoft, a bunch of other .com names. Now, guys, here's the great thing. Amazon's flat for 4 or 5 years. Apple's down from all-time highs. They're probably getting into the juicy area we want to buy them. Now, there's a way to take your cash that you want to use to buy Amazon and Apple. There's a way to do that where you can get paid on your cash to get those stocks at a lower price. So imagine that. Not only are you buying a company you want, you're buying it at a cheaper price, and somebody's going to pay you to do that. And then when you own the stock, somebody's going to basically pay you to rent the stock out. So you can make an extra 4, 5, 6% return a year, potentially, if done properly, to really accelerate your retirement. We call it the Retirement Accelerator. We have a great course coming up May 15th. Go, if you're interested in learning about this, it's a way to literally double or triple the money you have in your retirement and generate money on the stocks you currently own and get paid to buy stocks that you love at lower prices. So if you're interested in that, click the link below. It'll explain all of it to you, and I highly recommend it to anybody who's serious about investing. So let's see what Amazon reported. Net sales increased 9% from the same quarter previous year to 155.7 compared to 143. North American sales increased 8%. AWS, Amazon Web Services, up 17% year over year to 29.3 billion. Operating income, which is a great metric to look at to see how is the business doing, increased to 18.4 billion from 15.3. That is a 20% increase. That's incredible, guys. Net income went up to 17.1 billion from 10.4. Operating cash flow increased to 114 billion for the trailing 12 months compared to 99 billion previously. Free cash flow decreased, but I'm not worried about that for Amazon. Amazon has proven, and this is what I missed about Amazon 10, 12 years ago. Amazon has proven that they're experts at reinvesting back in themselves to make things easier for you and John Q. Public. That's what they're doing for them. Now, say what you want about Amazon. Don't look at the stock price. Look at their fundamentals just continue to get better. Look at this operating income that just keeps increasing right here. Oh, just look at this 2.2, 4.2, 4.1, 12.4, 14.5, 23, 25. It dropped to 12 and a quarter, up to 36, 68. Guys, this company is doing a great job of increasing its ability to make money. They're going to be around for a very long time. This is a company that deserves a premium. What's hard for me on Amazon is understanding the financials. Gross profit of 20%. Why isn't it higher? AWS alone is probably 80% gross margin or something crazy, if not more. It's hard for me to get around. Profit margin the last year, 9.29. The last 5-year average has been 5.5%. If you want to go look at what they've done in the last profit margin in the last 10 years, even worse than that. So it is hard for me to understand. but there's a value for Amazon that you've got to merge the story and the stock price, the numbers together to put it into our stock analyzer tool. So let's see what analysts are saying about this. Look at this earnings per share growth. They have estimates, huge earnings per share growth. Revenue growth, double digits, about 10% a year. But look at this earnings per share growth. This what tells me that their gross margin isn't really 20%. It's got to be higher than that. Got to be higher than that. I mean, it's incredible. All right, let's go check out Apple. Let's see what Apple's doing after hours. Apple right now is, wow, down 2.5%. That's interesting. Let's see what they reported. All right, guys, let's look at Apple. They just reported EPS of $1.65, beating $1.63. Revenue, that's a big beat right here for revenue, $95.4 billion, beating expectations of $94.5 billion. The stock is down after hours right now, as we see. So let's go pull up the Apple earnings report. Guys, Apple today announced financial results for fiscal 2024, revenue up 5% year over year, which, guys, for a company like Apple, that's a big, big jump in revenue. And earnings per share up 8%. Today, Apple's reporting strong quarterly results, including double-digit growth in services. So my theory on Apple is this is where they're going to get the earnings per share growth. Double-digit growth in services is going to be a high-margin business. So let's pull up Apple right here. We look at Apple right here, and its overall margin is 46.52 gross margin. It means every extra dollar they sell, 46.5%. But that involves a lot of hardware, and hardware is very expensive. So you go to services, it's a very, very high margin business because there's no product to manufacture. So I think this is where Apple can see a lot of growth in its earnings per share. That is incredible. 8% growth in operating cash flow to $24 billion, allowing us to return $29 billion to shareholders. Apple's board of directors declared a cash dividend of 26 cents per share, an increase of 4%. So Apple's so big, and it's hard to really grow their earnings per share and revenue. So what do? They have to sit there and buy back cheap shares and pay a dividend. I wish they wouldn't even pay a dividend. I wish it'd be a one-time dividend they pay every year or two, and they focus on waiting for the stock to fall to buy back cheap shares. That's how you're going to increase the value to investors. Even if a company is growing 4 or 5% a year, if you're buying back shares intelligently, you can grow the earnings, the per share price by 10 to 15% a year if you're buying back cheap shares at the right price. That's what's truly, truly important. Let's see their consolidated financial statements here. I love pulling this stuff up right here. So guys, look at this. Services, big jumps, 3 months ended, 6 months ended. Products, big time. I mean, the product costs went up, which shows they sold more product, or there's a big jump in their product costs because of inflation. Services, $23.9 billion versus $26.64. Look at this jump here. I mean, big jumps here, guys. Operating income up. Other income and expenses. Yeah, this is awesome. This is awesome. They did a great job. They did a great job. I want everybody to remember, though. Okay, look at that. Let's go break down iPhone, Mac, and iPad. So iPhone revenue up. Mac revenue up. iPad revenue up. Wearables, home, and accessories down. Services up for an overall about 5% increase. Guys, for a company this big to do this well, that's really freaking impressive. Look at their marketable securities, down from $35 billion down to 20.336. I wonder if it was the stocks going down or they sold some because their cash is also down slightly. Interesting. So we got to teach this over and over. It's possible to buy a boring company that has not much growth at the right price and still make an above average return. That's really important here. So Apple is considered like the foundation of this market. I believe we'll be at the bottom of the bear market, as my friend Michael once said, once people have given up on Apple. So let's look at Apple and let's run it through our stock analyzer tool. Actually, let's run Amazon. Let's try to run Amazon through the stock analyzer tool to see what we think it's worth. Because Amazon's a tough one. So I'm going to talk through my stock analyzer here on Amazon. I'm doing 4, 7, and 10% revenue growth. First line, what's the revenue growth? I'm doing 10-year analysis, 4, 7, and 10%. And I use Stock Analyzer as my starting points for stocks, as well as then when I've done more research and realize I want to buy it, the exact price I really want to pay. Profit margin, 6, 9, and 12%. Keep in mind, the profit margin of free cash flow, I actually have my low end as higher than the last 5 and 10 years. So I'm assuming they're really going to grow that profit margin. PE, What's the PE in 10 years? Well, guys, this is a premium company. It's going to be around for a long time. I love what Jeff Bezos says. He's like, listen, I'm not focused on what's going to change. I'm focused on what's not going to change. And people want cheaper and faster. And I love the fact he's doing that. So I give this a P of 20, 23, and 26, my low, middle, and high. Could you make the argument for higher? Absolutely. Could you make the argument for lower? Sure. But if you put 15 on this, I just don't think that's right for Amazon. I think this is a premium company. So I hit the analyze button because I do 9% desired return. I'm just trying to find, what do I think Amazon's worth? Now you have to have a margin of safety. And in order to put a margin of safety, that desired return needs to be higher. So I have a low price of 70, high price of 270, middle price of 145. So even with profit margin and free cash flow they've only seen in the last year, it's still kind of overpriced from here. But again, who knows what happens from here? But just remember my tweet before, I can't believe this, that this company is flat over the last 5 years. That's absolutely incredible. So guys, again, you need to understand our principle-driven investing. Click the link below, provide your email. We're going to email you our 5 tenets of principle-driven investing and why it's important for you to understand. This is absolutely foundational for anybody who wants to understand investing and be a truly great investor. Thank you for your time.